Arrow Electronics printed a massive double beat for Q2 2026. Non-GAAP EPS came in at $5.45, which completely crushed the $4.45 consensus.
Yeah, that is a massive beat.
It really is. And revenue hit $9.99 billion, beating the $9.67 billion estimate. So that's up 31.8% year over year.
Huge top-line jump.
Right. And looking ahead, Q3 guidance also topped the street. Management is forecasting revenue of $9.6 billion to $10.2 billion and EPS of 4.83 to 5.003.
So basically, strength across the board.
Exactly. But here's the kicker. Despite this absolute blowout quarter, the stock tanked over 8.5% on the day, dropping all the way down into the 206 range.
Yeah, it was a brutal reaction.
Okay, let's unpack this, because for anyone holding this stock or, just watching the broader tech supply chain, we're looking at a classic sell the news reaction.
For sure.
And those headline numbers are masking a much more complicated reality beneath the surface. Our mission for this deep dive is to tear down this earnings report segment by segment.
Right, we need to get into the weeds here.
We're going to parse the sequential margin pressures, evaluate some highly specific contract charges that are clearly spooking institutional capital, and figure out exactly what the market is pricing in for retail investors right now.
Because it's actually a perfect case study in how Wall Street processes information. Retail investors often look at a 31% revenue jump and just assume the stocks should be up double digits.
I mean, logically, you'd think so.
Right, but institutional models, they aren't grading Arrow on what they did last quarter. They're grading them on the structural integrity of their future cash flows.
So they're looking ahead.
Exactly, and when you look under the hood of this particular earnings print, you immediately see why those models triggered such an aggressive sell-off.
Well, let's start with the primary driver of that revenue surge, which is the Global Components division. On paper, the year-over-year metrics are just staggering.
They look incredible at first glance.
Right. Global component sales grew 39.4% year over year to $7.37 billion. And operating income for the segment surged 110%.
Doubled, more than doubled.
Yeah, with operating margins expanding 180 basis points year over year to 5.4%. So if you stop reading the 10Q right there, you probably assume Arrow is basically untouchable.
You'd think they were having the best year ever.
So help me understand the institutional logic here. If I'm an investor, I'm looking at a 110% surge in operating income. Why on earth would the market actively punish a company for making so much money right now?
Well, because that 110% surge is basically a rearview mirror metric.
Okay.
The market isn't punishing them for making money today. The market is punishing them for signaling that the easy money has already been made.
Got it.
To really get this, you have to look at the mechanics of technology distribution. Over the last couple of years, we saw these severe supply chain constraints combined with the absolute frenzy of the AI hardware build-out.
Right. Everyone needed chips and components all at once.
Exactly. When supply is scarce and demand is ravenous, a distributor like Arrow suddenly wields immense pricing power. They're the gatekeepers to the parts everyone desperately needs.
And that scarcity drives their margins up.
Up to totally unprecedented levels, yes.
But operating leverage is sort of a double-edged sword, right? Like, it works beautifully on the way up, but the moment supply catches up to demand, that pricing power just evaporates.
Precisely. And that brings us to the sequential data, which is what the algorithms and the analysts actually care about.
Right, quarter over quarter.
Yes. Overall operating margins took a sequential step down. They went from 4.2% in Q1 to roughly 3.8% to 4.0% blended for Q2.
Which doesn't sound like a lot, but for a distributor, that's meaningful.
It's massive. And on the earnings call, CFO Raj Agrawal explicitly noted that supply chain services are expected to return to more normal profit levels in Q3.
Oh, and normal is a dangerous word on Wall Street.
In cyclical distribution, normal is terrifying. When a cyclical company signals that hyper-profitable constraints are normalizing, institutions immediately reprice the stock based on the downward slope of that margin curve.
It frankly doesn't matter how strong the current quarter's EPS looks, right?
Mm.
Not if the models are suddenly projecting margin compression for the next 4 quarters.
Exactly. The past is the past.
It feels a lot like driving 100 miles per hour while looking in the rearview mirror.
That is a great way to put it.
You had this massive year-over-year beat, but the market is slamming on the brakes because they see a cliff up ahead. So if the cyclical hardware market is inevitably cooling down, you'd expect Arrow to lean heavily on their higher margin software and cloud business, right? Just to stop the bleeding and support the valuation.
You'd hope so.
But when we look at the Enterprise Computing Solutions segment ECS, we see the exact opposite happening.
Yeah, this is where the earnings report stops being a story about cyclical hardware and starts being a story about structural friction.
Let's look at the numbers because they are incredibly messy. Global ECS sales actually increased 14% year over year to $2.63 billion.
Which is solid top-line growth.
Right, and it's being driven by exactly the secular trends you want to see. Cloud migration, infrastructure software, cybersecurity. Management even highlighted their recent Microsoft Azure Virtual Desktop specializations.
All the buzzwords you want to hear.
Yes, exactly. But despite that solid 14% top-line growth, ECS operating income actually declined 12% year over year, and margins contracted 100 basis points down to 3.3%.
A total mismatch between revenue and profit.
And the glaring catalyst here is a specific $26.6 million to $27 million charge. And that is tied to the underperformance of non-cancelable multi-year purchase obligations.
Ouch.
Yeah, and if you look at the 6-month total, that charge has ballooned to over $48 million.
It's fascinating here is how that single line item completely alters the investment thesis for the entire company.
All right, because ECS is supposed to be the value-added software engine. It's supposed to be the high-margin cushion when hardware slows down.
It's their safety net.
So how does a segment grow revenue by 14% but see operating income drop 12%? Are they just incredibly bad at forecasting demand, or is this a huge red flag for their overall execution in the cloud space?
I mean, it is a harsh lesson in the mechanics of vendor commitments. To get the best possible pricing from massive software and cloud vendors, distributors like Arrow have to commit to significant volume upfront. They basically sign a contract saying, we guarantee we will buy X amount of cloud capacity or software licenses from you over the next 3 to 5 years. And they do that anticipating that their end customers are going to need it.
Wait, so they're taking on the inventory risk, even in a digital or cloud environment, like digital inventory?
Yes. And that is where the word non-cancelable becomes totally toxic to an equity analyst. Institutional investors despise that term when it's attached to a loss.
Because there's no way out.
Exactly. Think of it like signing a 5-year lease on a massive, expensive warehouse right before a recession hits. It does not matter if you have 0 boxes to store in that warehouse, you still owe the landlord the rent every single month.
Man, that's brutal. So end-user demand shifted, maybe moving to different cloud architectures or pausing deployments, but Arrow is still legally on the hook for that capacity.
You nailed it. So while the top line is benefiting from broad AI and cloud trends, the bottom line is being anchored by the poor economics of these inescapable contracts.
That creates a massive black box for anyone trying to value the company. I mean, if you're building a forward financial model, how do you project ECS margins when there is this lingering multi-year contract bleeding $27 million a quarter?
You can't. That is the crux of the issue right there. Analysts hate uncertainty more than they hate bad news.
Because bad news can at least be priced in.
Right. Uncertainty forces you to apply a discount to the entire valuation. You just have to lower your near-term margin expectations and assume the worst until management can prove they have this completely ring-fenced.
Which perfectly explains the 8.5% haircut the stock took. The hardware side is facing peak cycle normalization, and the software side is actively bleeding cash on poorly timed contracts.
It's a tough combination.
But management obviously sees the same stock ticker we do. So let's pivot to how interim CEO Bill Austin and the board are attempting to signal stability and defend this valuation.
Because they really threw everything they had at the market during this call to try and establish a floor.
They really did. I mean, Austin came out with some very specific bullish commentary regarding their order visibility. He emphasized that book-to-bill ratios remain well above parity.
Which is a crucial metric.
Right. For anyone tracking the industrial or tech space, that means they are receiving more new orders than they are currently shipping out. So that organically grows the backlog.
Yes, it shows future demand is still there.
And Austin noted that this backlog is building all the way out into 2027. Then they moved to capital allocation. The board authorized a massive new $1 billion share repurchase program, replacing the old one.
And that is a huge number.
Yeah, they bought back $43 million in Q2, but that $1 billion figure is clearly the headline they wanted the market to see. Finally, on the leadership front, they announced the appointment of Deidre C. Merriweather as the new president and chief operating officer.
Which is super interesting timing.
Right, she's stepping in to drive operational execution while the search for a permanent CEO continues. So let's focus on that $1 billion buyback authorization for a minute. Arrow's market cap sits right around $10.5 billion.
Roughly, yeah.
Authorizing $1 billion means they are threatening to buy back nearly 10% of the entire float. So, is management using a sledgehammer here to signal to the street that their normalized PE of 11.8x is criminally undervalued? Or is this just a thinly veiled piece of financial engineering to prop up EPS while they lack a permanent CEO?
Honestly, it's a bit of both, but functionally it acts as downside protection.
Okay, how so?
Well, when a cyclical company faces the kind of margin normalization we just discussed, the multiple is going to contract. The market will naturally compress that PE ratio.
Right, the stock price adjusts downward.
Exactly. By putting a $1 billion authorization on the table, management is essentially building a floor under the stock price. They're communicating to institutional sellers, hey, if you push this valuation down any further, we will gladly step in and retire a tenth of our outstanding shares at a deep discount.
So it scares off the short sellers.
Yep, it removes a significant amount of downside risk for current shareholders. But it doesn't necessarily fix the underlying business mechanics.
Which brings us to the operational side of the house. Why appoint Deidre Merriweather right now? Typically, a company waiting for a permanent CEO will hold off on major C-suite appointments so the new CEO can build their own team, right?
Yes, and that is exactly why her appointment is arguably the most critical fundamental update in the entire earnings report.
Really? More than the $1 billion?
I think so. You do not bring in a heavy-hitting operational COO during an interim CEO period unless there are severe operational inefficiencies that simply cannot wait another 6 months to be addressed.
Like the ECS segment.
Exactly. Connect her appointment directly back to that ECS contract bleeding we just analyzed. Arrow has a top line that is growing at 31%, but the bottom line is leaking cash due to poor vendor negotiations and sequential margin squeezes in their core segments.
They need a fixer.
They need someone whose sole focus is ruthless execution. Her mandate will be to audit those underperforming segments, restructure those toxic vendor relationships where possible, and tighten up the internal controls. So that top-line growth actually drops down to the bottom line.
So the interim CEO basically manages the board, communicates with Wall Street, and maintains the broad strategy, while the new COO gets down into the trenches and stops the bleeding in the software division.
That is the mandate, and they are operating on a very compressed timeline because the analyst community is heavily divided on how to price Arrow through this transitional phase.
Yeah, the analyst notes post-earnings reflect exactly the tension we are talking about. On one hand, you have Truist, who trimmed their target down to $250 but maintained a buy rating.
Probably leaning into that strong top-line growth and the backlog visibility.
Right. But then you have Wells Fargo, who maintained an underweight rating and slapped a $200 price target on the stock. And Wells Fargo cited a very specific mechanical metric that institutional investors are obsessing over right now.
The cash conversion cycle.
Yes. It is now stretched out to 272 days, driven largely by receivables expansion. Let's break that down, because a 272-day cash conversion cycle sounds alarming just on its face.
It is a massive drag on the business.
For those who don't live inside corporate balance sheets, think of the cash conversion cycle as like a money prison. It's the exact amount of time that Arrow's capital is locked up, spent on buying inventory from suppliers before a customer finally pays them back, and that capital is freed.
Right.
Right now, Arrow's cash is locked up for 272 days. That is almost 9 months where their money cannot be used for anything else.
And, in a zero interest rate environment, a bloated cash conversion cycle is annoying, but it isn't deadly. Capital is cheap.
Sure, you just borrow more.
Exactly. But in today's environment, where the cost of capital remains elevated, it becomes a severe anchor on the business. Remember, the role of a distributor, you are essentially acting as the financing arm of the global supply chain. You sit between the massive manufacturer and the end customer.
Right.
If your capital is trapped in receivables and inventory for 9 months before it turns into free cash flow, you are bearing a massive opportunity cost. A 272-day money prison acts as a heavy mechanical drag on your return on invested capital.
That makes total sense.
And that is exactly why Wells Fargo is remaining cautious. They're looking at the balance sheet and seeing massive inefficiency.
It all comes back to the quality of the revenue. You can grow your top line by 31.8% year over year, but if your operating margins are squeezing sequentially and you're taking $27 million hits on bad software contracts and your cash is trapped in receivables for 3/4 of the year, the market is simply not going to reward you with a premium valuation multiple.
No, they won't. It demands near perfect execution from the new COO moving forward because those macroeconomic tailwinds that carried them through the last 2 years, they are clearly shifting.
Which leaves us with a critical, forward-looking question to mull over, especially for anyone tracking the broader tech and semiconductor space. We heard management confidently state that Arrow's book-to-bill ratio is sitting well above parity today, and that their hardware backlog extends all the way into 2027.
Right, which sounds great.
But we also just watched the market aggressively sell off the stock over fears that hardware margins have already peaked. So what happens if this current unprecedented AI infrastructure boom is actually just pulling forward years of enterprise hardware demand?
Um, that is the existential risk being priced into the entire distributor ecosystem right now.
Think about it like the great toilet paper run of the pandemic. People bought 5 years' worth of inventory in 3 months. The grocery stores had record revenue for 1 quarter, but then the shelves just sat full and unpurchased for the next half-decade because everyone already had what they needed sitting in their garage.
Exactly.
If companies are panic buying AI servers and networking gear today to ensure they aren't left behind, what does the demand curve look like tomorrow? Are we setting up for a massive demand air pocket for distributors like Arrow in 2028?
If that backlog suddenly evaporates because the end users have over-provisioned their data centers, the margin compression we saw this quarter is just the tip of the iceberg. Yeah. The cash conversion cycle would stretch even further, and those non-cancelable vendor commitments would suddenly look even more punitive.
It is a massive structural question that will define the next leg of this AI cycle, and it's something you need to keep a very close eye on as these hardware deployments mature. That is all we have for today. Make sure you follow the show for your daily retail earnings coverage so you don't miss our next breakdown.